Good morning, everyone. Welcome to this webinar on internal control over financial reporting, ICFR, hosted by Grant Thornton and the Emirates Insurance Federation. My name is Sam Al-Hijazi, and I'm Head of Financial Services for Grant Thornton in the UAE. I'm joined by my colleagues in this webinar, Melissa, Partner in Business Risk Services, Dana, Partner in Business Risk Services, Harris, Director in Insurance External Audit, Yusra, Senior Manager in Business Risk Services, and Fahad, Senior Manager in IT Audit. The webinar is organized in the context of the new circular issued by ESCA, outlining key amendments and minimum requirements for implementing the governance guide for public joint stock companies in the UAE, and the webinar will cover the following topics: an overview of the regulatory requirements for 2024 and 2025, some of the potential challenges faced by insurance companies in effective ICFR implementation, some of the differences between internal testing and external audits, and ultimately, who is responsible for the implementation of ICFR. The implementation of ICFR in the UAE has been a journey and goes back to when the Abu Dhabi Accountability Authority adhere took a pioneering initiative and mandated ICFR for all adhere entities with adhere Resolution number 1 of 2017. Grant Thornton has been heavily involved in this journey since 2017, and we have always been vocal supporters of the implementation of ICFR since day one. We have seen and we can attest to the value that ICFR has brought to the quality of financial reporting in the UAE. ADA was subsequently followed by the UAE Insurance Authority, which also mandated ICFR, which unfortunately was delayed due to COVID. And subsequently, the UAE Accountability Authority has since mandated ICFR for all UAE federal entities, while ESCA has now mandated ICFR for BJSE entities. ICFR is here for good, and we expect it to become the norm for all major UAE government and commercial entities. We thank you for participating in this webinar, and I'll now hand over to Harris to commence. There will be time for Q&A towards the end of the webinar, and please note that this webinar is being recorded. Thank you again for joining us.
Thank you, Samar. Hello, everyone, and Ramadan Kareem. Just some housekeeping. If you've got any questions, you can type in the chat box, and towards the end, we'll try and answer those. So from an overall perspective, I'll be providing an overview of the regulatory requirements for 2024 and 25 pertaining to ICOFR. Recently, as Samar mentioned, in January, ESCA issued a letter, a circular, basically specifying certain audit requirements for ICOFR reporting. So in today's session, what I'll be doing is comparing three regulatory regimes and seeing what are the similarities, what are the differences, and how it impacts the insurance industry. As you know, ADA is the more mature of the three from an ICOFR implementation perspective, with ICFR being in place for some few years now. Central Bank, as you know, have had internal requirements for internal reporting by internal audit and management to CBUE. However, the requirement for external audit has been deferred for a few years, and we'll cover when is it expected to be in place for future. And then we'll also be covering the recently issued ESCA letter and how it impacts you. So from an overall perspective, we'll be covering ESCA and CBUE more. That impacts most of you. From an applicability perspective, you can see as in this table, ESCA requirements only impacts public joint stock companies in the UAE that are typically listed companies, and few other could include few other companies as well, but predominantly listed companies will be impacted. It does not include foreign branches of insurance companies. The ESCA requirement does include material subsidiaries. In contrast, as I mentioned, for CBUE, the requirement is for insurance companies, any foreign branches regulated by CBUE as well, and also material subsidiaries and associates in a phased manner is what they expect to be included within the ICFR scope. Like if I compare these two regimes, I mean, from a broad perspective, ESCA's purpose is financial integrity and ensuring that investors are protected, whereas central bank's core focus is on financial stability and solvency. So that we can see in both these regulatory requirements this stark difference, though there are a lot of similarities as well. In terms of a scope perspective, so at a broad level, ESCA requirement covers governance, risk management, and internal control practices, whereas the CBUE requirement is more focused towards financial reporting and to a certain extent regulatory reporting as well. In terms of which standard to adopt, ESCA has actually recommended COSO as being the leading framework and recommended companies to adopt this framework, whereas CBUE has not specified any framework. However, it has suggested that a framework is selected depending on the circumstances of the company, though there is a bit more flexibility. From a opinion perspective and what is required from your side from a reporting perspective for 2024. So for CBUE, as most of you would know, it is internal audit and management assessment report that is required for 2024. There is no requirement for a external audit. Compared to ESCA for 24, recently they have included a requirement to form a review. They haven't specified clearly what is review, and on the next slide we'll cover what is our interpretation of the ESCA requirement. In 2025, ESCA is pretty clear that a audit under ISA 3000 assurance standard needs to be performed, and we expect that central bank will also not defer the audit requirement in 2025, and it will be a requirement going forward. We've recently issued a thought leadership on ESCA letter issued in January. We will circulate the slides and this thought leadership with the attendees of the meeting, which basically shares GT's view on the ESCA requirements and how it impacts various companies. Now, I will be covering a few key questions on the ESCA requirements for 24, as these are the most recent ones, and I'm sure most of you will be interested in how it impacts you. So first of all, what is the scope of the ESCA requirement, and does it apply to foreign insurance branches? So first of all, it does not apply to foreign insurance branches. It only applies to public joint stock companies and its material subsidiaries. So foreign insurance branches will not be impacted by the ESCA requirement. However, they need to comply with the CBUE requirement. Then the next common question is, do insurance companies need to perform internal testing? So on this, yes, both for ESCA and for CBUE, this is a common ground on both, that internal testing is required. So internal testing could either be done in-house by management, or they can outsource it to a third-party vendor. CBUE specifically for 24 specifies internal audit being involved as well, whereas ESCA does not specify who performs this testing and leaves it up to management to decide if it is internal management or they outsource it. We will be covering who's responsible for this testing and overall responsibility of the implementation in later slides. Now, an important question is, what is the scope of the external auditor? Specifically for 2024, which is the year which has just passed, and many of you have already got your financials signed, so there is a lot of confusion in the market. So just as an overview, large firms, which includes the top 6 firms within UAE, we have a forum. In the forum, we have discussed our questions with ESCA. There are few open questions. However, we do have consensus over several items which I can share with you today. So in terms of the scope, I mean, if I can use the word, this will be like a mock audit, because the purpose of ESCA's requirement is to prepare companies and ensure they're ready for the actual requirement which comes in 2025. So what the mock audit means is that the company will complete its implementation. It will perform internal testing over the implementation and operating effectiveness of the controls. Then external auditors will come in this year, 24, and review the work that has been done. Review is a very broad term. So how large firms have decided to narrow it down is that we will be looking at key implementation benchmarks, such as, do you have a RCM? Is it mapped to a framework? What is the basis of the materiality selection, and what is the basis of testing done by management? And then we will review the testing done. We will not be issuing an opinion on the 2024 year end. We will only be issuing a private board presentation to those charged with governance. And this is a common consensus amongst the large firms. Whilst ESCA doesn't specify what our presentation will include, to ensure consistency within the market, the large firms have agreed on certain areas. Then a common question is that if you're subject to multiple regulators, which I'm sure a lot of you will be, which requirement should you follow for ICOFR reporting? So from an ICOFR reporting perspective, what we say is follow the most stringent requirement. So if regulator A is asking you to do A and the regulator B is asking you to do additional procedures, always select the one with the additional procedures, just to ensure you're complying with both the requirements. There is one open question with ESCA right now regarding external audit, which could have broad impacts. That is that in the current requirement from CBUE, it clearly specifies that auditor scope is internal control over financial reporting. So that is specified. Whereas the ESCA requirement doesn't mention ICFR specifically. It also includes governance and risk management as well. This basically would bring a lot of additional scope within the external audit purview. However, this is not a practice globally, so we have reached out to ESCA and we're currently awaiting their response in terms of clarifying if it's just ICFR or do we need to do a wider COSO level review or audit. Then from a last question is, what is the deadline for compliance for 2024 and 2025? So for 25, ideally the best practice is that the financial statement audit and ICFR audit report is issued at the same time on the same day. Whereas this is a recommendation, it is not mandatory. What is mandatory is to have your ICFR audit being completed before the AGM. So before AGM, you need to get the ICFR audit done. However, it's recommended to get it done with your financial statement audit. For 2024, ESCA is flexible. What they've mentioned, they haven't given any fixed deadline. What they've said is, as long as this is done before 31st December 25, they're happy with that, and there's no need to complete it before the AGM. We currently do have an open question with ESCA that what happens if the auditor is rotating and a new auditor is being appointed at AGM, then who's responsible for the testing? This question is currently open. So this was just a brief overview of the ESCA requirements. I'll share the thought leadership as well, which will include further detailed to explain what I've just mentioned. I'll just hand over to my colleague, Melissa.
Thanks, Harris. Good morning, everyone, and thanks for being with us today. So pursuant to what my colleague Harris has just mentioned about some of the questions that we know are kind of going around in everybody's head, or maybe going around somebody's head, we also know that there are some challenges that insurance companies are currently faced with, given that the ICFR requirement has become more apparent, more clear, and a lot more time sensitive, put it this way. We have done quite a few implementations that started with the financial services sector as a whole, but when we zoom in on insurance services, there are very specific challenges to the industry that we wanted to talk to you about. I'll just mention a few, and if you have been affected by some but not all, or have not yet, bear in mind that these are some of the elements that may prevent the effective implementation, the timely implementation, or the adequate implementation of the ICFR standard and its testing. So we'll start off first with the absence of structured guidance for implementation. What we mean by this is that there isn't a standardized framework that is very specific to the insurance industry where you can just kind of say, okay, this is what applies to me and how it applies to me, which causes some inconsistent practices as well across the industry. There's also in that, because of the absence of the framework, there is an ambiguity in terms of whose role and whose responsibility it is, in which team has what responsibility as part of this ICFR implementation. The second thing that we see is ineffective control environment, which may be something that is ancillary. So the insurance company or the company may have some weaknesses in its control to begin with, where there's a weak governance to begin with on the oversight, and controls or the control environment is not prioritized. So having this as an ancillary or an inherited kind of issue to deal with can also hinder the ability to implement ICFR effectively. And with that, if you do have that weakness in the environment, there will be a certain cultural resistance from the perspective of, why are we trying to reinvent the wheel? Why are we trying to do something different here when we have talked about controls at length and so on? So that may be a challenge coming from the ineffectiveness, having an ineffective control environment. A third thing that we also see is the misplacement of the ICFR function. Believe it or not, I have seen it placed under IT, for example. There is an IT component, but I think we can all agree that it doesn't entirely belong there. We've seen it sit under internal controls, under finance, under internal audit. And the answer to this, and we'll get into the details in the next few slides in terms of who are the departments that need to get involved, but who the ultimate ownership should sit with. Because of that, there's also a lack of accountability, right? If we don't know where it's supposed to be sitting and who's supposed to be leading it, there's always going to be a lack of accountability. Another thing that we see as well as a challenge is a lack of cross-functional collaboration. ICFR is something that the entire organization, or at least the departments that are affected by it, have to be working together, and there needs to be governance on the whole process, but there needs to be different efforts led by the various departments like finance, IT, compliance, and you want to make sure that they're not operating in silos, because all of that has to come together for it to make sense. And of course, they have to come together and have proper communication process amongst each other for this to work properly. When we talk about subjective materiality, we talk about the materiality in terms of what should be included and what shouldn't, being very subjective, not just from an organization perspective, but from a department perspective. So whenever there isn't a proper definition in terms of what these thresholds should be from a materiality perspective, the different departments may not consider the same threshold from a financial perspective or non-financial perspective, and therefore you will have misalignment across the different departments. So these thresholds should be defined across the board. It cannot be subjective. Then we talk about another challenge, which is the lack of awareness for internal controls and regulatory requirements. As we've seen, the regulatory requirements are quite dynamic. They're changing. They also leave room for interpretation or misinterpretation, or a lot of grays. So we try to see how we can actually minimize that gray and how we can make sure to adapt to swift regulatory changes and having the right partner to support you through that. We also talk about absence of resources, infrastructure, and skill set. Here we talk about not having, and this is something that we hear a lot in terms of why some clients might come to us for support. It's maybe they know how it should be implemented, maybe they know how the testing should operate, but they don't have the time to allocate, they don't have the resources to allocate, they may not have the skills to allocate within those specific resources so that they can actually do the work within the timeline required. So hopefully by attending webinars like this, you can have ample notice on how you can upskill, on how you can get the support that you need, how you need it. From an infrastructure perspective, some controls need to be automated. For example, we see that there are times where the challenge is that these controls embedded in systems are not automated or don't have the capability to be automated, which could generate a lot more issues in the long run. One more challenge that I wanted to mention here is, we talked about, swift regulatory changes, absence of resources, as well as lack of awareness for internal controls and regulatory requirements. I think what you see is there's obviously, different challenges that you can come across, but if you see these challenges coming ahead of time and develop a strategy to tackle them, and this is what I will hand over to my colleague Yusra Hamid to get into the details of each challenge and how we can address them from a strategic perspective. Yusra?
Thank you, Melissa. Good morning, everyone. So I'll take you through the challenges Melissa highlighted a bit more in detail. Here we will not just identify the challenges, but we'll also explore the actionable solutions to address them. So let's start with the first challenge, which is the absence of structured guidance for ICOFR implementation. Now, considering we don't have the step-by-step guidance for ICOFR implementation, many organizations struggle with how to effectively implement ICOFR and even often fail to understand its importance. While we understand that the ICOFR is a regulatory requirement in line with the Insurance Authority Circular of 2019, now overseen by the CBUAE, and the ESCA latest decision of 2024, the ICOFR implementation benefits extend far beyond the compliance only. However, many organizations perceive the ICOFR exercise as an additional burden rather than as an opportunity. So just from that perspective, when ICFR implemented effectively, it actually enhances the governance by clearly defining the roles and responsibilities, strengthen the risk management by focusing on the high risk areas, and improve the overall operational efficiencies through streamlined and automated controls. Regarding the implementation, ASCA has recommended the COSO framework as a benchmark, where we have its 5 components and 17 principles, and this framework provides a well-structured, however, a flexible approach and a foundation to implement the ICOFR. As per the leading practices, we have designed a phased manner approach that links the key activities with the deliverables to ensure a comprehensive and effective ICOFR implementation. Our overall strategic ICOFR implementation approach comprises of the 6 stages. So instead of rushing the process, a phased manner approach allows for better planning, gradual learning, and a smoother transition to a fully compliant control environment. Haris, if we can go to the next slide, please. So here we have the 6 stages or the phases where we have splitted our methodology or the approach to implement ICOFR effectively and comprehensively. Starting with the first phase, which is the scoping and mapping, where we start with obtaining the understanding of the organization and develop the ICOFR framework, capturing the high-level elements like the applicability, how to do the scoping, how to conduct the assessment, what would be the methodology, the approach for the sampling, and all those things. High-level governance document would be this ICFR framework. And then we'll move to determine the materiality from quantitative and qualitative both aspects. Once we are there, we need to map the significant account balances as well as the class of transactions to the relevant processes. The output for this phase would be the scoping and mapping document as well as the ICFR framework document. Then the second phase would be to obtain the understanding and document the process as is, where we'll understand the processes, we'll document that, identify the risk, and then we'll move to developing the risk and control matrices. Now, what's the role of the risk and control matrices is basically to correlate the risk with the related controls you have in place. Once we have that in place, then we need to even assign the control owners for the future monitoring perspective, as well as few other domains like specifying the type of the control, the frequency of the control, and different domains to make it more comprehensive. The deliverables at this stage would be the process description documents, which will be highlighting that this is a process and this is a control and this is how it will flow to your RCMs then. Then we have the RCMs and the entity level controls checklist. Based on this second phase, the gap assessment will be executed where the design level deficiencies and weakness will be highlighted. And those gaps needs to be rated based on their financial reporting impact. So here we have the gap assessment report as a deliverable at this stage. Based on this, we need to develop the management testing plans in stage 4 for which we will be then executing the testing in detail to evaluate the control's effectiveness, which is the stage 5. Once we are here, we need to get the observations validated by the stakeholders. Once we have the buy-in, then we'll move to the final and the last stage, which is the reporting. So here we will be preparing a comprehensive report touching base on all the control weaknesses and the remediation plan, everything. And once we are here, we also need to finalize the ICOFR framework document. So for example, the draft was there in the phase 1 itself, but here, if there is any updates required as we go along the phase by phase approach, the last stage will give you a time to even make those amendments there. Now, in the scenario where you have enough time in place to implement ICOFR, how the usual organization even take it, they actually go with the first 3 stages in a one go, and they opt for a cooling off period during that time, once they are completed with the gap assessment, to actually remediate the design deficiencies they have. And once they are sorted with that, then they'll move with the development of the testing plans and executions of the control effectiveness. That's more effective if you have the time. But when we have stringent deadlines in place, then all the 6 phases approach can be executed or conducted in a one go as well. Now moving to the second challenge which we have is the ineffective control environment. The key issues we have here is the inadequate governance structure, which is mainly because of the lack of clear accountability for ICOFR and weak mechanism for reporting and the deficiencies in the governance element. So for example, like the transparency issues, integrity and accountability concerns. Then we have highlighted the other issue as a weak tone at the top. So it refers to the overall ineffective control culture of the organizations that could be because of outdated or weak policies and procedures, lack of code of conduct in place, unclear delegation of authorities, or even if it's clear, it's not yet, it's again outdated, and the insufficient board oversight as well. Then the next issue we have highlighted is the lack of integration with the overall control environment, which could be because of the absence or inadequate enterprise risk management framework or the compliance framework. The solution we recommend here is to promote a culture of ethics and integrity through the leadership, establish a clear organization structure, develop and communicate entity level controls in line with the COSO framework. The next challenge, which is one of the important aspects, is the misplacement of the ICOFR function. Is basically to decide where you have to place the responsibility and accountability to implement and monitor the ICOFR. Now, the issue here could be the independence conflict. So if ICOFR responsibility is placed within the first line of defense, the objectivity can be compromised here. And the other concerns we have highlighted is the unclear reporting lines and the weak oversight. So without the overall clear oversight, ICOFR efforts may be ineffective. The solutions to these challenges is to position the ICOFR either in the second or third line of defense with a direct reporting line to the senior management and the audit committee. And then to establish a strong governance mechanism, including independent reviews and a structured reporting to the board. The ICOFR implementation cannot be executed in silos, and all different departments actually have to join their hands to make it effective. So there is a challenge, which is a lack of cross-functional collaboration, which comes because of the communication barriers between different departments or their misaligned goals and the objectives. So because of the conflicting objectives, sometimes departments, end up prioritizing their ultimate goal rather than ICOFR. So the solutions could be to have a centralized task force who actually can monitor the communication coordination among different departments and can also support or act as a project management for the ICOFR implementation. The other is to have a shared KPIs aligned with the ICOFR. So when the individuals are aware that they have the KPIs in place and their performance will be evaluated, they are more motivated and inclined toward implementing this. Then there should be a dedicated leader and or a steering committee that, this is the ultimate project management domain who's running the show. The other issues we have is the subjectivity involved in the materiality. So defining appropriate materiality threshold where we actually lack with a clear criteria that how actually to evaluate or assess the materiality, what all subjective parameters we need to evaluate, and what could actually be the material quantum of it as well. And to balance the financial and non-financial factors as well. The solution here is to develop a clear materiality guideline and to collaborate with the external auditors. Now, this is one of the very important points which we even emphasize to our clients, that when you are starting your implementation exercise, try to discuss this with your external auditors in advance, that this is the materiality you are going to leverage to actually implement it. Now, while doing that, you also need to keep a buffer that, for example, one class of account is not material this year and could be material in the next coming years. So that buffer is a management call to incorporate, but overall, it's better and recommended to discuss the materiality concerns or the benchmarking approach with the external auditors. And then we have the different tools. If management has the luxury to afford that, then definitely nothing like it. Then the next challenges we have is more around the lack of awareness for internal controls and regulatory requirements, where we have limited understanding of ICOFR benefits. Employees actually, sometimes fail to recognize how ICOFR can enhance the financial accuracy and reduce the fraud risk. And there is also a resistance to change. So controls are often perceived as a burdensome rather than adding value, which we even discussed initially. And then there is one more challenges of inadequate training programs. So the solutions we can have here is to launch awareness campaigns, provide tailored training programs, appoint ICOFR champions. This ICOFR champions is also one of the motivating factor among the stakeholders, what we have experienced. Then the other challenge is either the absence of resources, infrastructure, or the skill set. The key issues here is either limited budget allocation, lack of specialized ICOFR expertise, or the inadequate infrastructure. Now, to secure the dedicated funding from the management and to convince them to actually invest in this, we need to demonstrate the values the ICOFR implementation will bring in. So that's one of the element which once you are yourself aware that these are the benefits, you can improve in all these manners, then the stakeholders will also be quite comfortable in making those investments. Either to build the internal expertise through training, upskilling, or otherwise you can leverage the third-party vendors as well. And then to adopt a solution to automate the overall ICOFR processes. The last challenge we have is adopting to the swift regulatory changes. So with evolving regulations, frequent updates over the ICOFR framework, and compliance with multiple regulatory requirements are few of the concerns. Here how we can actually remediate is by developing a flexible framework which can adopt the regulatory changes we can foresee in the near future, and to create a central repository with the regulatory requirements which should be accessible to different stakeholders, and establish a monitoring process to track and ensure the compliance with all those regulatory requirements. So that's all what we have today around the challenges. And now I'll hand over to my colleague Mohammed Fahad to take up the other areas.
Awesome. Thank you, Yusuf. Thanks, guys. My colleagues have made my job a little bit easy. So my job here is to guys explain you what is the actual difference between internal testing and external testing. To be honest, it's quite a piece of cake, but yeah, in the end, you guys will have to report, so it's gonna be easy. So I mean, it's always debatable when it comes to internal testing, and it's by the management or internal audit. What it means that is the internal testing has to be done. So if you get to the next slide, Haris. So now when it comes to internal testing, if you're doing a testing in operational controls or in internal audit, you can just check the risk-based areas and just move on. As Yusuf was explaining, like if you don't have quite a bit of framework, we can just do testing or whatever the risk-based, things that we think of. But when it comes to the financial reporting in terms of the ICFR, first, if you need to have a product where you can do an internal testing. And this product has to be defined quite in a detailed way, because you will be testing not only you, and then in the end, external party would also be evaluating it as well. So I get a lot of questions that, where we start, how do we start? As a part of my, experience with this ICOFR group, right. I think so. Something happened to the technology. So I was just saying that we need to define the materiality, and once the materiality is defined, what we need to do is select the material accounts as well. Now, this is very important that we need to make sure that there are correct accounts are selected for our testing, because again, as I mentioned, that if you're doing an internal testing, only then somebody else will be able to do and evaluate our framework. Now, once we have done this thing, we need to make sure that, because, and again, as Ishra was mentioning in the start, that our scoping has to be very crystal clear. Now, when you're part of a management, or all we're doing is internal testing to put a framework in a place, and as my esteemed colleague has mentioned that. Eska has mentioned about the coastal framework. What we need to make sure is that there is there's a proper framework in the place where we have identified key accounts which relates to our financial statements. Because do understand that it's good that when you're doing an internal audit, you have a big scope and you can do whatever you like to test. But when it comes to the ICFR, when it comes to the scoping of the ICFR, obviously your key accounts are the material accounts which are impacting your financials in the end, basically. And then obviously the most important thing is you need to communicate those accounts. Now once those, as I saw very quietly mentioned, all the key challenges that she has faced, and it's something that we always mention, that is the ICFRs, when are implementing, are not implementing in silos. You have to communicate them to the wider audience, to the whole of the group as well. Now, if we go to the next slide, Haris, please. Um, so then the next slide, what we have is, I've just given an overview, right? So now you have a long business, and everybody has their own business demands. We are very different. Obviously, we're all insurance companies, but we have different, business cycles. Some business cycles can be material, some cannot be material. But what I'm trying to explain to you in this slide particularly is just to give you a summary, right? That these are the business cycles that they are there, and some of them can be key. Now it depends. Now this is going to be internal audit who's drafting the proposed, drafting this framework and testing it. It has to be his decision. Now, this business cycles would come either from the materiality. Now, obviously, based upon the materiality, if these things are material, then this will be tested as a part of the internal control framework, or as a part of the obviously as a part of the ICFR. But to reach to that product, right, to reach to the product where we can actually perform an internal testing, first of all, we need to make sure that we have done those steps. Now, if you go to the next slide, one of the things that I have done is a part of this thing is normally I've got asked question. I think from the partner Melissa said it very correctly, that sometimes you feed ICFR in the IT department, which is quite wrong. Why is it wrong? Because IT has nothing to do with any of the materiality, any of those things like that as well. But on the same side, IT is also the backbone. Now, nobody, and I'm pretty sure nobody over here in all the insurance companies, they are in the raw cages and are using pen and pencil to record the claims and insurance. I'm pretty sure you guys are not doing that. If you're doing that, my apologies to that. But again, you guys are using some sort of an ERP, some sort of an application where the claims are coming up, where you're calculating your insurance or your insurance and things like that. So all of these things are happening on a proper platform. Now, this proper platform is your application or your OS or the DB or a domain, anything like that. Now, this gives quite a credibility or significance to your infrastructure in an IT. Now, this is where IT is quite significant. But again, IT is not a direct part of that. IT is indirect part of that, because these parts are really linked to the society. Now, if you go to the next slide, Harris, again, in the next slide, I put some red dot on corporate tax reporting as well. Another big reason is that obviously tax is not, it's not a big key account if you're comparing with the reinsurance and things like that as well. But from the compliance perspective, it's quite a big thing as well, because obviously of the new corporate tax laws that has come up as well. So what I'm trying to illustrate over here is that it is your duty, those drafting the ICFR, that guys, we need to make sure that when we're testing this product has a proper rationale behind it. Just starting from the materiality, there's a proper communication, there's a material accounts have been selected, and based upon that, there's an IT over there as well, and is a linkage happening as well. Jusha mentioned a very important thing that she mentioned about the frequency of the controls and type of the controls. Now, all of this has to be done first before you start testing from the internal side. Because again, do understand that ICFR, as all of my esteemed colleagues have been mentioning, that starting from the Salman and Harris, that this is a requirement. In the end, someone else would come up and test it. And he and she, whoever comes in, if it's us, it's going to be best for you guys, is that we're going to see what is the benchmark you guys have selected, right? And we're going to be reporting on what you guys have already done it. We can't remake the cycle. We can't redo it because as an external thing, if we are acting as an external party, we would be looking as a part of your internal controls which have been developed as a part of the financial reporting. Now, if you're part of an ICOFR where we have been developing it, then we can do a fantastic job. But if it's done by the management or internal audit, they need to make sure that somebody else would come and review their business cycles, starting from materiality. Now, we go to the next slide. It's now in this slide, the key things is some people, and this is something I know some people like to have, all right, guys, now we have done the materiality, we have done everything. What we can do is just test the controls. I said no. And why I say no is because if you're drafting the controls, it has to be either by backed up some of the process. Now, one of the key things that we normally see as part of internal controls backed up is by policies. Now, in policies, you cannot make all the controls as the policies because some policies are general in nature. So the controls have to be specific in nature. And this is one thing which is very different, which you need to understand when we're doing an internal testing is maybe policies, obviously policy would cover your operational parts. Policy might cover your compliance parts. Policy might cover your regulatory parts, right? But again, as I said in the start, being defined in materiality is you are targeting the things that are impacting from your financial perspective, right? Which are impacting your finances. So it would be always good when you're testing internally, make sure there's a proper process narrative in place against a material account, as we mentioned above, and then there's a proper process narrative as well. And then process narrative against the flow of transaction, which you're trying to explain how your insurance, reinsurance policies work, how your claim work, things like that. And then you are linking to a control basically in there. So if you go to the next slide, what I've done here is that sometimes you're quite aggressive, you're quite ambitious, and you made a lot of big process, and then you do a lot of controls as well. Now, this is again the management who's drafting the ICFR. It lies upon him that they can identify these are key controls and these are non-key controls. Now, what does it mean, like non-key controls? Non-key controls can be some of the controls which are not impacting your financials from an internal testing perspective, but you have developed it as a part of your being process. Does not mean you have to test it, but it means that the risk was there, which you've identified as a part of your ingoing framework. Now, this is just like a high-level overview where you have to draft internal control framework before it's being tested. Now, if you go to the next slide. Now, in this next slide, what we have is an IT. The most important part, which I'm here to advertise, is that it's an IT. What as a kind of start, we have everything is based on IT, right? Everything starts with IT, goes with IT, but unfortunately, it is the least department where we're given attention to. The four big areas where we look on an IT is on the governance side, which is on the top level, then there's the access side, and there's the changes, anything that goes into the application, and it goes, for example, you have a new tax law, where you have to change the tax, provisions, or there's a new thing. Then what you have to do is you have to change it. Based on how do you change it, is the proper change has to go in place, the proper rules in place as well. What I'm trying to say is that you have to have proper controls when it comes to the IT, the four main areas, changes to the access, security, and to the operations as well. Now, let's come to the next slide. Again, I'm just giving you an overview this is where I'm prepping you up, because you can't just go and start testing an ICFR unless you have a proper thing in place, which my colleagues have mentioned in the name of RCM, which is called as risk control metrics. You can give the name whatever you want, but what we're trying to establish here is that there's a proper control framework in place. Now, in this document, which you can see, there's some of the key examples of material account that I've scoped in, what are those accounts as well. And then based upon what was the business cycle, and against this is the material accounts. Now, please do understand that as a start of being doing an internal testing, we need to be assured of these areas first. Then we can do internal testing. It's not like a risk-based area where you just go and just see the risk, and this risk can be of any nature, and then you start testing. In an ICFR world, you need to have a strong framework behind it, which is backing up with your number of aspects like materiality, like scoping, how you have done it, how you have calculated it, what are your material accounts, and then obviously you're linking to the controls and to the financials in the end as well. Now, this is just an example. If you go to the next slide, now what I've all talked about was on the process level controls, your insurance, your reinsurance, and tax. And I keep saying insurance again, because I understand that's a very key account. But on the other side, we have to look at the top as well. And when I say the top, is that at the entity level controls. Now, some controls are very linked to the entity level controls. And why we are signifying here is because as the hardest start in the start is that there is from ESCA, there's a COSO framework. And in the COSO, you have a proper guidance when it comes to the entity level controls. Now, there are 5 main areas. As you can see, there's control environment, risk assessment, control activities, information communication, and monitoring activities as well. Now, COSO is very granular when it comes to the entity level controls, because COSO has given quite a lot of you can say, points of focus, that what you need to cover as a part of testing. Now, I've come across a lot of insurance companies where the internal testing, they understand is that they have to test all the 88 point of focus, or they test all the 18 principles, because the 5 components are mandatory. Yes, that depends upon you. Again, it is the decision of the internal management. What they feel fit, what they feel relevant is what they have to test as a part of the internal testing. Once they have established that these 5 components with 18 principles with X number of point of focus are in scope for the testing. Now, once they've done it, now this is what they've done it. They say they have tested ELCs, which is called as entity controls. They have tested PLCs, which was the process level controls, where they have put the process narrative, they have put the scoping, everything is done. Now they have done the job. Now this is where a proper risk control matrix in place. Now, if you go to the next slide. No, so I think some of the slides missed. But I'm going to stop here in the end, just before I hand over to my Dana colleague. Just one more slide over here was this, that once this has been done, you have to have an external audit that will come there and that will evaluate. Now, the risk control matrix is only formed once you guys have done internal testing. Please do note that, as my colleague Harris and Yusra and Melissa, they all said it as well, that external audit will not create an RCM. External audit will come and test the RCM. That is already in place, and that has already been tested by the management. So external auditor will not come and reinvent the wheel. External auditor will come and test the control framework that has been in place, which is either part of the management or the part of the internal audit as well. And this is where, and the external audit would give a conclusion not on the process level control, not on the process level, not on entity level, but on the control level. Please do understand that in an ICOFR world, external auditors would always provide a conclusion on the control level. And then obviously it becomes at the end at the overall level as well. But the conclusion will also come at every control level as well. Thank you so much, guys. I'll hand it down.
Thank you so much, Mohammed and my peers in Grant Thornton. Good morning, everyone. My name is Dana. I'm a partner in Grant Thornton. And now that we've understood much more about ICFR, comes in one of the most critical questions. Who's responsible for ICFR? Who truly owns it? And who is going to implement it? Now, ICFR is not just a compliance exercise. It's a strategic necessity. The ultimate responsibility normally relies with those charged with governance, the board. And the board will, in multiple model, delegate this responsibility to basically either the CFO or the second line of defense, or it would become a cross-functional project, which is the best model that we have seen. Now, one of the model is that the finance or the CFO would basically take ownership of implementing ICFRs on behalf of the board, and there will be clear accountability and reporting lines to the board, because the ultimate responsibility is with those charged with governance. Now, having said that, although in most of the occasions we've seen the CFO leading the implementation, or the finance team, financial management team leading the implementation of the ICFR, this is basically the effectiveness of the ICFR is not the only responsibility of the CFO. It's the responsibility of the cross-functional teams as well, because the first lines of defense is available on daily basis to implement the controls on daily basis, and they sit outside the finance department. So it's very important, even if the CFO or the finance team led the implementation of the ICFR, that basically the first lines of defense is responsible for the effectiveness. Effectiveness of the ICFR is a cross-functional responsibility in the organization. Now, this is one model we've seen when it comes to implementing the ICFR. The second model we've seen is that it's been assigned by the board or those charged with governance to the second lines of defense. Sometimes it's the chief risk officer, sometimes it's the chief compliance officer, and other function as well. Now, this is one of the model that could work out in collaboration or in close collaboration with the CFO and the finance team. The third model, which is a good model, is the cross-functional model. It could be led by the CFO and also basically the second line of defense contributing from their insights and reports on the what could go wrong in the organization and the improvement areas. Information security could be part of it. The risk management team could be part of the steering committee or the project team, and the compliance and risk management could be part of it as well. So these are the three models that could be implemented in applying the ICFR, regardless of who's leading on behalf of the board. It's very important to mention that the effectiveness of the ICFR is not the responsibility or not the only responsibility of the CFO. It's a cross-functional responsibilities between the different lines of defense. Having said that, moving to the next slide, which is the 4 lines of defense. As I described earlier, the first lines of defense is those basically the other functions sitting outside the finance team, responsible for the daily design and implementation of the controls. The second line of defense comes in financial reporting, financial control, security, risk management, quality, which could contribute significantly to the effectiveness and the design of the ICFR if they were consulted in this project. And then comes in the internal audit. It's very important to mention that the internal audit, and also as an ex-chief audit executive, I should mention that internal audit should not design the ICFR. It's basically a management responsibility. Internal audit could support basically in testing the effectiveness of the ICFR if they were assigned with this engagement after the approval of the audit committee. And then comes in the 4th lines of defense, which is the external audit, issuing an opinion on the effectiveness of the design and effectiveness of the ICFR implemented in the organization, and also a regulator if a regulator is auditing as well the entity, which constitute the 4th line of defense. This is in a nutshell the ICFR and who's responsible for it and who should basically implement it in the organization. We've seen multiple models. The best model basically is not a silo model, a model that basically where everybody contributes toward the design of the ICFR and also the effectiveness of the ICFR. And this comes when ICFR is a joint project between multiple functions. However, CFO could, or the finance team could lead it directly in one of the model that we have seen. This is in a nutshell the ICFR implementation, and we will move to the next session, which is the Q&A. Please feel free to put your questions in the Q&A box. You will see it on the top, and we're more than happy to answer your questions, and I'll hand over to Samer if I've missed anything. Thank you for listening.
Thank you very much, Dana. Thank you, everyone. Thank you, ladies and gentlemen, for your time today. So we do have time for a couple of questions. We've already received a couple, so we'll start with those. I'll ask, so the first question, what about reporting coverage for internal auditors? So if I could put that one to Yusra to respond to, please.
Sure, Samer. So the first question and even Samer, the second question are actually interconnected. The second one is the ultimate responsibility for management and the internal auditors. So here we have to understand that the overall responsibility.
Yusra, Haris, can you just go to slide 11 so people can see on screen, please? Sorry, Yusra, go on, please.
So when we talk about the roles and responsibility, this actually be governed by the ICOFR framework, where those charged with governance has to define that who will be responsible for what. Now, for ICOFR specifically, we have 2 domains. First is the implementation at a first instance, and then we have the regular or on a frequently basis, a management testing phase. So as Dana mentioned, definitely the implementation of the ICOFR can have perceived conflict of interest if we assign that job to the internal audit domain. So, however, the internal auditors can be assigned to support the management testing phase or the self-assessment part. Now, for mature organizations where they have enough bandwidth within their second line of defense, where they are actually implementing as well as managing the management testing of part as well, then the internal audit role would actually be to come and execute independent audit altogether, evaluating the overall ICOFR effectiveness, because that somehow is one of the scoped area which we have seen as part of the IA plans as well. So it depends upon the maturity or the size of the organization. If they have enough bandwidth, then there would be altogether a separate internal audit on ICOFR domain. Otherwise, the internal audit can actually take up the management testing or the self-assessment part. I hope I have answered the question adequately. If still you need any clarification or something, you can drop the other question as well. Thank you.
Thank you, Yusra. We also have a question about ICFR implementation might come with extra costs and efforts. Melissa, do you mind commenting on this one, please?
Sure, I'd be happy to. Thank you for this question. So while we understand that this requirement is a regulatory requirement and we have been given ample notice by the regulators, or the standards specifically have given us heads up in terms of by when this should fall into play, there should have been some allocation to it from a budget perspective, but I appreciate that there would be some cultural resistance, as I mentioned in my slide earlier. So the benefits could be discussed with the management depending on the organization. It's not one size fits all. It's all going to depend on putting yourself in their shoes and what matters to them. So in general, we talk about obviously the regulatory component, that you would avoid regulatory penalties, or you would avoid any kind of slaps on the wrist for not being compliant. So that one is the stick of it all. But let's talk about the carrot specifically. So when we say carrot and stick, so here we're talking about the potential financial impact that it could have. So implementing ICFR could support the reduction of potential misstatements, potential financial misstatements, and ensuring that there is the right level of implementation also supports operational efficiency as well, because you are controlling the financial reporting process from a control perspective, but also from an efficiency improvement perspective. So we do talk about its ability to actually help with fraud prevention, which, there are examples where insurance companies have been able to save quite a bit of money in terms of, ensuring that they have the right levels of controls. And I'm sure this is something that would definitely motivate management from how it can affect the balance sheet. It also supports on a business continuity level and on a risk management level. So we talked about risk management being from a fraud prevention perspective, but also increasing the risk awareness. So understanding what are the potential risks, be it operational or financial risks, through this exercise would also support business continuity in the future in terms of the business's ability to quickly adapt to regulatory changes or to market changes to ensure that it does have the right level of practices in place from a business continuity perspective. You can also demonstrate that it increases investor confidence. It all depends, again, on the structure of the organization, who the main stakeholders are, and if you're trying to just motivate management, or you want to motivate the committee or the board, etc. They each have different incentives, put it this way, or different interests in terms of how they look at the organization, what ICFR can do for them. If it's a matter of ensuring misrepresentation is minimized, if it's a matter of ensuring that we're increasing investor confidence by having the right level of governance and the right level of control over financial reporting. If it's operational, so we're talking about management actually minimizing the amount of friction they see in financial reporting from a process perspective, increasing efficiency, increasing accuracy, as well as the overall reliance on the information. And it also does facilitate the overall process from an external auditor's perspective, where you have the right documentation in place. It facilitates the testing exercise that would be done by your external auditor at the end of the year. Hopefully that answers your question. I know there's a lot more I could say on this, but we don't have all the time for this. But if there's any follow-up questions, I'm happy to take those as well.
Thank you, Melissa. Look, I think we're coming to the end of our session. We'll just respond to a couple more questions. Any questions which we don't have time to respond to, we will draft responses and share them with the Federation, and they will share the responses with you. But the next question is about the deadline of the ICFR report from the ESCA point of view. Is it before the AGM date? So, Hades, if you could respond to that one, please.
Sure, Samer. So there are two parts to this question. First is for 31st December 25 year end, which is yet to come. So for this, yes, you need to get it audited by external auditor and complete the internal testing before the AGM date, and the report should be issued. For 31st December 24, which is the year that has just passed, ESCA is flexible, and they've mentioned that as long as it is reviewed by the external auditor by end of the year, that is the current year, 2025, it will be fine. So not the AGM date for 24. Hope that answers the question.
Okay, thanks. And I think last question in the interest of time, how will we handle this in the insurance foreign branch, given the code of corporate governance is still under development? One for you, Haris.
For insurance branches, I mean, it's the CBOE requirement which will apply, which basically is more focused towards the financial reporting aspects of it rather than the governance side. What we understand that we will hear soon from central bank as well on the governance side during the year, which will hopefully provide more clarity before the testing for 2025. So as I mentioned earlier, the ESCA requirements do not apply to insurance branches of foreign companies.
Thank you, Haris. Thank you, team. And thank you, everybody on the call for your time today. We hope the session was useful. Like we said, there are a few questions in the chat which we haven't had time to respond to. So we will take them away in draft responses and get back to you. We will, subsequent to the call, share a version of the slides with you through the Federation. And we look forward to cooperating further with everybody on the call around this area going forward. Thank you very much again for your time today.
Thank you.